Stocks did jump with the gains in the Dow led by Nvidia. The tariff-induced volatility taking a backseat again today. The Dow and S&P 500 posting back-to-back gains. Joining us now, Ryan Dykmans, Dunham Associates Investment Counsel, Chief Investment Officer. Thanks so much for being here. So as we looked at the rally today, we were talking a little bit about how maybe yields coming down were a catalyst, but I'm curious how you see the setup in the market right now and whether you do think the risks are sort of tilting more bullish or bearish.
Sure. So, I'll start off by saying we see risk as being not very well compensated, right? The valuations that we're paying right now to get the growth that people are excited about for 2025, I feel like when you put a risk premium on that, I don't know if we're really hitting those numbers. So I don't think you're getting compensated for risk, and therefore we've been trailing back a bit on how much we're allocating to equities across the models where you can do that. I would say to the levels of being half exposed to equities where we can.
You have your very own quantitative model over there, Ryan. I'm just curious if you could walk us through that model. What's it measuring and what's it telling you?
Sure. Yeah, so it's looking at market values over time. It was developed, with a very long, obviously every model starts with the back test. But the idea behind it is looking at valuations, and it's looking at versus historical movements. So basically, if you're looking at choppiness in the markets, it's looking at those opportunities for, periods where we get a drop at whether it's 5, 6, 7%, appears to buy in. And then obviously when it runs back up, appears to sell out. And it's not one of those that's a complete binary on off. It's actually dialing in and dialing out. The cheesy thing I like to say is I like to be generally right than precisely wrong. So I'm not trying to pick tops and bottoms, just trying to release some of my equities as the prices have been going up and buying bonds, because I am excited about the bond market going forward from where we're at today. Exactly you said, with yields poised to drop a bit, we'll see.
Well, let's dig a little bit more into the dialing back in stocks that you described, sure. That you're not getting compensated properly for risk right now in the equity market. What are the risks that you're most concerned about? That could be potentially cause hits to the market?
Sure. So, large growth is one of those areas where I would say we see the least compensation for that risk. So that's where we've dialed back the most. So not only within my equity allocation have we been dialing it down altogether, but our actual exposure to growth is substantially lower than, I'll say, most of my peers, and also than the S&P, just as a broad kind of, broad benchmark. But the risk that would topple that, obviously, at some point, these themes that people have priced in and said, hey, we think these are going to live on forever. That's how they're basically pricing a lot of these companies. I think that eventually you get a reality check, and sometimes it's from an external force, something like a DeepSeek comes out and says, hey, there's another way to do this. Sometimes it's through retaliation through the tariffs, right? Something like that can upend some of these companies. I'll say the trend that people have bought into.
Within your U.S. equity allocation right now, Ryan, how exactly are you allocated?
Sure. So, less than a quarter of it actually is going to be dedicated to, we'll say, pure large cap growth, which means that we're looking at almost 80% towards those other asset classes. So when people talk about breadth and the idea that, small caps will have their day, and, I'm one of those people that pounds that table, but value, value is also something that's been underrepresented in most portfolios. We're very heavy on value. We see value stocks as an area that, not necessarily it's going to be 2025 is going to be the year, but we do see it as a good, I'll say, return for the risk we see behind it. So going back to downside, I think large cap growth has a long way it could fall. I think large cap value, maybe looks a little more attractive in that realm if we do have a sell-off.
And Ryan, turning to the bond market, I got to be honest, we don't meet too many folks who are enthusiastic about the bond market these days, which I think is what you just said a few moments ago. Sure. There are a lot of risks potentially to the bond market as well, right? Whether it is that the Fed is not going to cut anytime soon, whether it's that we are going to see some upward pressure on inflation. So why do you like the bond market here?
Sure. So actually, it's funny you ask, because it's one of the first searches I did when I did a manager search was in the bond market. So I was looking at bonds before even equities 20 years ago. And so when I did that, one of the things I loved about it is there's so many different facets. You talk about equities, people generally hit your small, large value growth. In bonds, there's thousands of instruments to play with. So we've actually, within high yield, that's one of the areas we have our largest weighting. So we have about a 40% weight in our high yield kind of exposures, mainly because we don't see credit risk as the looming risk. It's more about rates, right? So keeping a lower duration, lower interest rate sensitivity and getting paid a little more for it with a higher coupon, we've been liking high yield, but alternatives is the other spot that we have been really excited about, specifically fixed income alternatives. We do include event-driven investing like merger arbitrage in our fixed income alts, but we also use things like long-short credit, basically the ability to dial back both duration risk and credit risk and still collect that yield. So just looking for things that don't behave like necessarily the rest of the bond market, like the Bloomberg Ag might behave. We aren't necessarily tracking that exactly. We're looking for just capital preservation, positive returns. That's why I'm excited about it.
Gotcha. Ryan, thanks so much. Appreciate your time.
Thank you for having me.